These oil and gas companies have attractive dividends and strong financials. These are the oil and gas stocks to buy for healthy dividend income and steady dividend growth. Chevron Corporation. The company has an investment-grade balance sheet and healthy operating cash flow. Occidental Petroleum. Occidental Petroleum has a large asset base with a focus on debt reduction. Aker BP ASA. Low break-even assets coupled with steady production growth will ensure that cash flows remain strong. Let's dive in. Here are the 3 oil and gas stocks to buy for healthy dividend income. Welcome to Timely Investment Research. Crude oil has corrected from highs in 2022 on fears of a global recession. I believe that this correction is a good time to look at some of the best oil and gas stocks to buy for an attractive dividend income. Even with the big focus on renewable energy, the demand for oil will remain strong in the coming decade. I must also mention that OPEC Plus announced a surprise production cut last month. It's clear that the objective is to support oil prices as demand sags on a relative basis. In all probability, the worst of the correction is over. Therefore, there is a possibility of oil trending higher in the second half of 2023. My focus is on 3 quality oil and gas stocks to buy that provide good dividends. I also believe that these stocks will continue to deliver steady dividend income growth in the coming years. Let's discuss the reasons to be bullish on these stocks. Number 1. Chevron Corporation. Chevron Corporation is the best bet among oil and gas stocks to buy with a dividend yield of 3.6%. As a matter of fact, Chevron Corporation stock has managed to remain steady amidst market volatility in the last 12 months. With the company showcasing strong fundamentals, it seems a rally is imminent. Further, the company is positioned for sustained dividend growth. A big positive is that Chevron has an investment-grade balance sheet. As of first quarter 2023, the company reported a net debt ratio of 4.4%. This gives Chevron high financial flexibility for aggressive investments. The company has already planned for annual capital expenditures ranging from $13 to $17 billion through 2027. It's also worth noting that Chevron reported operating cash flow of $9 billion for first quarter 2023. Even with some correction in oil price, the company is likely to deliver an annual operating cash flow in excess of $35 billion. Therefore, the company's dividend growth should remain healthy for at least several more years. Number 2. Occidental Petroleum. Occidental Petroleum is another quality name among oil and gas stocks to buy. It seems to be among the favorite portfolio stocks for Warren Buffett. The 1.18% dividend yield stock is attractively valued, and I expect healthy dividend growth in the coming years. Last year, Occidental focused on improving its credit metrics. The company managed to repay over $10.5 billion of its debt. This represented 37% of the total outstanding principal. With healthy cash flows likely to continue, debt reduction will remain in focus. Occidental aims for an investment-grade balance sheet in the coming years. If they manage to achieve that goal, higher shareholder rewards are likely. It's also worth noting that the company ended 2022 with proved reserves of 3.8 billion barrels of oil equivalent. With a healthy reserve base and an attractive break-even asset profile, Occidental is well-positioned to create shareholder value. Number 3. Aker BP ASA. Aker BP ASA stock has a current dividend yield of 9%, and I believe that stock is undervalued. As an overview, Aker BP is focused on oil and gas exploration activity in the Norwegian continental shelf. The company has quality assets, a low break-even, and a strong balance sheet. Aker BP reported revenue of $3.3 billion for first quarter 2023. For the same period, the company's earnings before interest, taxes, depreciation, and amortization was $2.9 billion. Further, operating cash flow for the quarter was $1.7 billion. Clearly, their earnings before interest, taxes, depreciation, and amortization margin is robust, and the assets are a cash flow machine on the back of a low break-even. For first quarter, Aker reported production of 435,000 barrels of oil equivalents per day. The company expects to boost production to 525 MBOT by 2028. The guidance seems conservative because Aker has been active on the inorganic growth front. Additionally, the company has 770 million barrels of oil equivalent in net oil and gas resources. With strong financial flexibility for exploration activity, healthy production growth is likely to continue. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.